Now, our final step in assessing the liquidity position of the company is to apply the model cash conversion cycle. We must understand the concept, the computation. You have to remember the idea in finance, which holds that liquidity position of a company depends on how the working capital is funded and the time it takes to liquidate or convert the working capital into cash. Liquidity is ultimately determined by two variables. Finance theory holds that liquidity of a company is ultimately determined by its working capital. The amount of working capital it holds, the financing of the working capital amount, and the conversion cycle, the time it takes the working capital to convert into cash. We have seen the financing of the working capital in the model liquidity position. Now we want to establish the time it takes or the number of days it takes the inventory to convert into cash, to become cash, means to sell the inventory and collect the money, and the time or the number of days it takes the company to collect the cash from account receivables, and the time it takes to repay its accounts payable. That model is model 3, and we shall call it cash conversion cycle. It's also called operating cycle of a company. Cash conversion cycle refers to the cash inflow period and the cash outflow period of the company. So we calculate the cash conversion cycle, or CC. Our formula is cash cycle equals to AAI, average age of inventories. Focus on the word age of inventories. That means how many days the company holds its inventories before it turns over to customers, plus ACP, or average collection period. Companies normally sell their goods to customers on credit, so they have to wait for some time to collect the money. So from here, we will determine the credit term of the company, in how many days customers pay to the company, and then we deduct the APP, or average payment period. Now, as you can see from the formula, we need 3 numbers. AAI, let me write these numbers. AAI is an acronym for average age of inventories. ACP stands for A for average, C collection, P for period, the number of days it takes the company to collect the trade account receivables, and ABP is on the supply side. A again for average. APP stands for average payment period, which is a measure of the number of days or time it takes the company to pay its suppliers. Now we need to compute this. First, we have to have the data, the year 2023 and 2022. We must collect the numbers from the balance sheet. Then the computation will be straightforward. To collect these numbers, we go to the balance sheet. Because we are dealing with average numbers, we write here this column, we call it average amount. First, let's call it A. We begin with inventory amounts. inventory. We collect it from the balance sheet under the current assets. That number is on the balance sheet under the current assets. It is row number 16. And then for the year 2022, the same place, but different year. And then we average them out. So equal the inventory amount for the year 2023 plus inventory amount for the year 2022 in brackets, then you divide by 2, average number. You can also use the Excel to compute directly. We have the average number. That number is important. Let's highlight it. We do the same thing, but this time for trade account receivables. Trade accounts receivables, or AR, accounts receivables. This is also from the current assets section of the balance sheet. You go to the row number 12. Those numbers, we already have them. I just show you where they come from, but we have them in the first model when we were calculating the WCI. Same numbers. Then we take it from row number trade account receivable, row number 12, column D and F for number 22 and 23. Now we have to calculate the average. We do it the same way. This number plus the amount for 22, and then we divide by 2. That is the average trade account receivable. We have computed the average amount, and average means the beginning amount and the ending amount. We add them up and we divide by 2. Our final number, next number is trade accounts payable. That is the supplier side, trade accounts payable, or A/P. We source this number from the balance sheet in the liability section, current liability section. It's on row 48, trade accounts payable for both years. Row 48, column D and column F. So just like before, we calculate the average number, beginning amount plus the ending amount, and then we divide by 2. We have the average inventory amount. We have the average inventory amount. We also have the average trade account receivable amount, the average trade accounts payable amount. We must have 2 more numbers, which is the sales and service revenue per day. Now, to calculate that, we take the total sales amount for the whole year from the income statement, and we divide by the number of days in 1 year. Then we can get the per day amount. You say equal. We open the income statement, which is the second sheet, PL9. We have the total amount of sales on the top line. This is the total sales amount, 374 billion. But that number we divide by 365 days. in order to get the sales amount per day. We are assuming there are 365 days per year. So the figure 374 shown on the income statement is the total amount for the year 2023. To convert it into per day, you divide that number by 365. You do the same thing also. This is for this number for 2023. We also going to calculate the cost of sales and services per day. Cost of sales and services. Cost of sales and services per day. We do the same thing. We open the BL sheet, profit and loss. We have to calculate the cost of sales and services per day, which represented the production cost or cost of providing the goods. So we take that number from the income statement and we divide it by 365 days. Now that number is negative because it's a cost. To get it per day, we multiply it by -1, just to turn it into positive. I'm going to repeat that. We must have the cost of sales and services per day. So we begin with equal. We take the number from the profit and loss statement. Cost of sales and services, 352 for the year 2023. We divide that number by 365 days to make it per day. But the number is negative because it is a cost. To make it per day, we multiply it, positive number. To change it to positive, we multiply by -1 because days cannot be negative. So we have to convert it into positive. So we get 964. With these numbers, first we calculate AAI, average age of inventory, equals to the cost of sales per day, E, average age of inventory, which is this figure, average age of inventory, that number, we divide by the cost of sales per day. That will give us the number of days, 40 days. We can write the formula, AAI equals to average inventories divided by cost of sales per day. We calculate the average age of inventories. So we write down the formula first. AAI equals to average inventories divided by cost of sales and services per day. Cost of sales and services per day. Now to do that, we say equal. We have the numbers both. This is the average age of inventory, average inventory amount, and this is the cost of sales per day. Taking these numbers, following the formula equal, average inventories, this is the number, we already prepared, divided by cost of sales per day, that is E. We get 40 days. The unit is days, meaning it takes this company 40 days to produce or buy the goods and sell to the customers. On average, sometimes fast, sometimes business is slow, but on average, it takes this company, Panchak Corporation, about 40 days to deliver the goods to its customers. Now we calculate the ACP. Our assumption is that the company sells the goods on credit. If they sell on cash, it will be immediately. Collection will be immediate. But since most companies sell on credit, we have to determine how many days it takes the company to collect cash from the customers. That's called ACP, and that is average trade accounts receivable divided by sales revenue per day. We have all the numbers. We have already prepared the data. This is the average account receivable, row number C, and this is the sales per day. So we take these two numbers, we highlight them so that they match. This is the two numbers we will use to calculate the collection period, equal average account receivable divided by the sales per day, 27 days. It takes the company on average 27 days to collect cash from the customers. If we add these two together, 40 days for selling the goods plus 27 days for collecting the money, it takes 67 days Panchak Corporation to sell and collect cash from the customers. 67 days. That is called cash inflow period. 67 days. Our last number is to calculate the APP on the payment side. Average trade accounts payable average trade accounts payable divided by the cost of sales per day. To calculate the APP, we must have two numbers, the average trade account payable divided by the cost of sales and services per day. They pay the business suppliers 36 days. Now we can finally calculate the cash cycle of the company, and the formula was AAI plus ACP minus APP. We have all the numbers equal. AAI is 40 days plus ABB 27 days minus 36 days. It's about 31 days. All the units are in days. 31 days is the final answer for AAI of Model 3. It means on average, the company receives cash every 31 days. Now the rule of thumb is, this is a good number. It shows the company's liquidity is good because they collect cash fast. If the CC cash cycle is equal or longer than 2 months, it's normally considered to be bad. Our number for this company is 31 days. It is less than 2 months or 60 days, which means it makes money quite fast. So that will help the liquidity position of the company. Now, to wrap it up, it means we wanted this company to determine, to evaluate the liquidity position of the company, Panchak Corporation. We have used 3 different models. One model is an accounting approach, that is current ratio. Current ratio is good, the number is good, it shows the company liquidity position was good. Then we use a financial approach, that is the LP, liquidity position, and the cash conversion cycle, CC. Liquidity position of the company indicated that the liquidity position of the company is good. The last 2 models, LP and cash cycle, are financial approach. The concept here is that liquidity of a company depends on the amount of its working capital or the sources of funds used to finance the working capital and the time it takes to liquidate or convert the working capital into cash. Now we are going to wrap up this hands-on session. We wanted to analyze, evaluate the liquidity position of the company. We have taken an accounting approach and a finance approach. And in the accounting approach, we have made use of the current ratio model. The current ratio model for the year 2023 was 1.39 and 2.33 for the year 2022. If the ratio is greater than 1, it means liquidity is good. What that means is the company, as of December 31, 2022 and 2023, that is the dates of the balance sheet, the company was holding sufficient amount of current assets to cover its current liabilities. So liquidity is good because the ratio is greater than 1, but year 2023, the figure is lower than last year, it's showing declining liquidity position of the company. In the finance approach, we have considered both the financing side and the investment side. Finance approach holds that the liquidity of position of a company depends on its working capital, the source of funds used to finance the working capital investment amount, and the days it takes to liquidate the working capital to generate cash. We have used the liquidity position of the company, LP, and we have established that more than 100% of the working capital of this company was financed with long-term funds. Financing side is long-term, investment side is short-term. Working capital are short-term investments in inventory and account receivables. The number is greater than 100% because the other 17% indicates that the company used also long-term funds for cash investments. Again, the trend is the same. The LP for 2023 is lower than the LP of 2022. Although the company is liquid, its ability to repay is declining. The second approach was the conversion cycle. We used the model cash cycle. So we have computed the cash cycle, and we have determined that cash cycle of the company is 31 days for 2023. That figure is lower than the standard of 60 days, 2 months. It means it takes short period of time relatively to convert the inventory into cash. All in all, our analysis shows that the liquidity position of the company was good, and that means low liquidity risk. Thank you very much.